There's only one place to begin, and that's with this. What do you make of all this market volatility? Is it the beginning of the bear market some people have been waiting for? Is this just another pause on the way to higher highs like we've seen so many times in the past 5 years?
I think it's going to be kind of difficult. The simple reason is everybody's waiting for the midterms. I think what you're going to find, at least sort of our belief, is if Democrats get control, I think you're just going to have a lot more volatility. And the reason you'll have more volatility is you're going to have more headlines. You're going to see more of all these problems that you're having in D.C. with the president and Congress.
Between the House and the administration? Is that what you're talking
about?
The House
because
and the White
House? Democrats need to get control of the House. If they don't, then I think you will find the markets going up. I think what's happening is the markets are starting to focus on the fact that if Democrats get control, you're going to have a lot of issues. And those issues are not good for the economy.
So you believe that what we've seen over the past 5 days, more than 5 days, say past couple of weeks, is a reflection of political risk being priced into the market?
I think political risk is getting priced in. I think you've got a lot of economic issues, and what you're finding, the other economic issues, is how much is the economy going to grow? So equities need an economy to grow around sort of 2 to 3%, right, or 3 to 4%. Bonds need sort of flat to up 1. For what we do, all we need is an economy doing what it's doing. So whether the economy is up 1 or the economy is up 2.5, that's great for us. But for equity markets, you need to still have this steady growth. And I think people are getting nervous about whether that growth is there. And then you're getting nervous about what's happening on the political side.
Let's talk a little bit more about that political side. When you say we're going to have, if in fact Democrats take control of the House, when you say there's going to be more volatility than what we've seen, what does that look like? What does it look like from November the 6th through year end?
Well, if you take a look at what's happened over the last 2 years, right? Whenever there's been issues within the administration, a Republican-controlled Congress has made those issues go away. So the biggest one would just be investigations of the president. So if you have a Democratic-controlled Congress, so a House, you now will start having those investigations. And I think the market doesn't want to deal with that, right?
Why? Because it's bad for business?
Well, just because what the market wants is you want to know what's happening.
Certainty.
Certainty. That's exactly it. The more uncertainty there is, the more headline risk there is, the more issues you will end up having.
So to what degree, Marc, do you care about this as a credit investor? Are you looking at the market today and what you're predicting, if you will, between now and the end of the year and saying that's a sell signal, or is that a buy signal?
Well, for us, it's a buy signal. But the reason for us, we like uncertainty, right? The more people are nervous, the better it is for me.
But if it's going to get worse between now and year end, why not wait? Why not sit back and wait till after the midterms and it's more chaotic than it's been?
You know, that would be great. So if you could tell
that would be great.
If you tell me where the bottom is, I would love that, right? I would love to know always the bottom. What we're very good at is understanding value. So buying something at 60 cents or buying something at 50. I don't know if we're ever going to time the bottom, but we'll be very good at buying at pretty low prices.
Let me ask you about spreads. We can look at the equity market.
Sure.
And try to decide whether we have seen or will see a bottom for risk assets on the basis of what's going on in the Russell 2000 or the S&P 500. But you're in the credit world, and there are a few ways we can measure it. Let's just start with high yield spreads. 380 today. Does that feel like the bottom to you?
I actually, when I look at that, I don't even remotely see how you're getting paid for that risk. If you take a look at today, investment grade bonds today, 50% of those bonds today are trading at levels that are sort of triple Bs. So when you look at that, that is from 10 years ago, that ends up being sort of multiples of what it was. In any slowdown, you're going to have bonds drop pretty quickly. And for us, at least what we'll see is we think we'll be able to buy investment grade bonds that are trading today at par. Once there's any problem with rates moving up or anything, we'll be able to buy those bonds at, somewhere around sort of 60 cents.
60 cents on the dollar.
Yeah, 60, 70 cents on the dollar.
That means
there's going to be issues. I love issues. More issues. Just give me issues.
When does that happen? By how much do rates have to rise? And where on the curve? Are we talking about what the Fed is doing, or are we talking about a repricing of the middle or the long end of the curve?
I think as rates move up, they've got to go up about 100 basis points. And they will.
Market rates or
just the Fed
funds?
Fed funds has to raise rates by 100 basis points. As they do that, the cost for companies, because everything's a floating rate, starts moving up. And then what everybody's going to focus on, see right now, what people focus on is how much is the economy growing by, right? If you sort of look, where's the economy going?
3.5%.
Right. Now, if rates are 100 basis points higher and the economy is only growing, let's say at 2. Well, if it's growing at 2, that means the economy is contracted by a third, right? So from 3.5 to 2, 2.5. So all everybody's going to talk about is a slowdown, as opposed to the fact that you're still growing at 2%. So once that changes, that psychological change happens, what you'll see is the markets will start to focus on, hey, when are we going to be hitting that?
You don't believe that psychological change is happening now?
I think
and the reason I say that is because the market's a discounting mechanism, and we can look at what the Fed thinks it's going to do with interest rates, and if you have any confidence in that, predict that 100 basis points may only be 12 months. In some cases, not even 12 months away.
I think it's starting, but you need more issues. And you need to have more problems. And I think we'll start seeing that.
Is a 100 basis point increase in the overnight lending target enough to trigger the distress cycle?
I don't know if it's enough. It's the beginning of the cycle, right? So to sort of use the baseball analogy, I think right now we're in the second inning on the distress side, right? You're getting
pretty
there.
early.
Yeah, it's very early. You want to sort of get to the middle innings, but we'll get there. The question is, how long does it take?
I want to go back to this point you made about being able to buy investment-grade bonds that are trading at par at 60 cents on the dollar. That happens after 100 basis points, or is that somewhere out in the future?
No, that's somewhere out in the future. I think that's over. Look. The reason I don't think you're getting paid for that risk today, if you're an investment grade holder, 80% of all the bonds that are being issued are covenant light, right? So you've got less covenants, you've got a lower coupon, you're just not getting paid enough. So whenever there's going to be a problem, right? In the past, you could look at the covenants and that would end up holding the price up. Now the only thing that's going to be there, you've got one covenant when the money's due. So that's why bonds will drop, because everybody's going to go, well, I've got no covenants. The only thing I can do is ask for my money back. And so that's where the fight begins.
You make a great case, Mark, for shorting liquid credit.
Yes.
Are you shorting liquid credit?
We're short some, yes.
Where specifically?
High yield index. High yield index.
What are you buying then?
Well, right now we're buying quite a bit in sort of the power sector on power
Utility
companies.
Stuff?
No, just like on the power companies that are having issues because their debt has to be restructured. Retailers that are having some issues right now where we think the value of the real estate is worth a certain amount.
Can we name some names?
When
you say retailers, people want to know if you're talking about Sears. I presume not.
No, Sears. No. No, JCPenney would be a name that people would know. Neiman Marcus would be another name that people would know.
Those credits look attractive at today's prices.
At where the bonds are trading, we've been buying some of those bonds. We've been selling, coming in and out. So depending on where the pricing of those go, that's where we've been taking advantage, and a number of other idiosyncratic type of opportunities. So for us, we've been pretty busy. We haven't had a problem investing capital today.
What do you think about a couple of the investment grade issues that have been selling off pretty dramatically over the past few days? GE, for example, and IBM.
Look, I think they're fine. I think the issues those companies will have, especially GE, IBM I'm not as worried about. But GE, I think it's got a lot of issues, and that's something that we're starting to look at. But that's probably still about a year away for us.
So the bonds aren't yet clearing at the right price?
They're still not cheap enough.
Not cheap, but they might be at some point.
I hope so.
The outlook for the economy. how much recession risk do you see? And to what degree do you factor that into the buying decisions that you make? Do you need a wider margin of safety, a cushion, than you did, say, even 5 weeks ago when everybody thought everything was fine?
I think, look, the economy's fine. It is. The economy's, whether we're growing at 3, 2, or 1, for what we do, it's great.
Still money good.
Yeah, it's still money good. I just need, what I want is as you've got issues, as the economy is slowing down a little bit, people are going to get nervous, but we'll be able to buy that debt. Like, I'll give you an example of something we're doing. Telsa. So, great company. It's got about sort of $40 billion of equity value. We're factoring some of that paper. And what I mean by that is people are coming to us and saying, I don't want to take the risk that I'm not going to get paid in 90 days. So we'll
on Tesla.
On Tesla. So we're buying that around sort of 95, 96 cents on the dollar, and we're getting paid, 100 cents on the dollar in 3 months. So when you take a look at that, you're getting massively overpaid for that. Why? Just people are nervous. But from an economic standpoint, I would look at that company and say, there's nothing to be nervous about. I've still got $40 billion of equity value. Yet people are nervous. And that's
irrespective of whether Elon Musk is successful over the long run or not.
Yeah, well, look, my kids are buying Teslas. I mean, I know what's going on there. I look at the equity value. But at the same time, from a business standpoint, we're making 10, 12% on a piece of paper that we shouldn't be.
Mark, what's it going to take for the market to start punishing the companies with bad balance sheets, over-levered, that for some reason have just been skating along, even, in the post-QE era?
Yeah, you need two things. You need rates to move up. That's number one. Everybody knows they are, but the question is by how much and how quickly. And you need a slowdown. So if all of a sudden you're talking about the economy growing at 2%, then people start getting nervous. Because you're growing at 2, you're worried about it growing at 1. Like right now, it's growing at 3.5. What are we talking about? Is it going to go to 2? You're at 2, is it going to 1? Is it 1, or are we in a recession? So it becomes then, if you're worried about a recessionary environment, it's hard to raise money. If you're not worried about a recessionary environment, you can still raise money because you're going to say, hey, we're going to have growth.